When it comes to investing, many people are worried and hesitant to get started. Some think they can't do it at all. Investing seems to be very daunting, and you constantly have doubts. You're always wondering how you can do it the right way, always second-guessing yourself. The reason for this is most likely the number of myths surrounding investing. These myths usually start out when someone makes an accurate observation. However, it may only apply within a specific time period or a certain context or market. Whether these myths have merit or not has little to do with how widely they may be believed. Here are some of the common misconceptions that may change your outlook on investing. 1. Investment decisions should be made based on recent returns. Just because a fund or stock did well in the past, it doesn't necessarily mean it will do well in the future. When it comes to investing, you're never sure of anything. Successful investing is about having a fluid approach to market volatility and being aware of the risks involved. If real estate is trading, for example, you'll be more inclined to invest in it. But before you do so, you have to understand that every asset performs differently, following a particular cycle. What works today may not work months or years to come. A stock's current performance shouldn't be the only reason to invest in it. 2. You have to wait until you're older to invest. You could choose to wait, but there really isn't a right age, is there? A lot of people tend to push things or postpone them till later on, rather than utilize the time they have now. You'll tell yourself, I still have plenty of time to invest in the future, but no one's sure of what lies ahead. Things happen, and between now and the time you're planning to retire, so many things can happen that will ruin your plans. The cost of living could change at any moment. Life expectancy is unpredictable, and you may fall ill or even lose your life. Having all these factors in mind, it would be the right move to start investing as young as possible to guarantee a better future. Investing sooner allows you to take advantage of reinvesting and compounding, no matter how small you put in. By investing your money, the returns you make will go a long way in countering the effects of inflation, meaning your money retains its value by the time you retire. 3. You need a hefty amount of money to invest. When people think about investors, the image that pops into their head is that of high-powered Wall Street types with millions of dollars at their disposal. But truthfully, anyone can invest. Warren Buffett, one of the most successful entrepreneurs, is believed to have started his investment career with a stock that costs $38 per share. A number of investment firms have small minimum requirements, and some none at all. Recently, brokers have developed apps and programs that allow you to invest starting with very little. Even pocket change can be used to start with. This misconception has deterred people from investing, but in essence, you don't really need a lot. Consider investing small amounts of money regularly. This will reduce the risk from market conditions over a certain period of time. You could try buying fractional shares of a company, or you could try an index fund. Starting small also means you can start early, because the older you get, the more financial commitments you'll have, making it hard to set money aside to invest. 4. Avoid risk and volatility at all costs. There are always risks in investing. You can't run from them, they're inevitable. Selling your stocks every time you think the market is going down as a way of trying to avoid risks will do you no good. In fact, this will only harm your returns in the long run. Attempting to time the market is very hard, and it's likely you'll always sell too soon, and this will just delay your returns. The best way to go about this would be to diversify, as this minimizes loss by spreading the risk. Diversification gives you the chance to own risky assets, which have the potential of producing great returns, without risking the portfolio as a whole. Most experts consider a portfolio more heavily weighted towards stocks riskier than a portfolio that favors bonds. But risks should be embraced and managed at the same time. As an investor, you need to find your comfort level and build your portfolios and expectations accordingly. And as the common saying goes, no risk, no reward. 5. Gold is the safest bet. The thought of investing in gold is very enticing. Gold is viewed as the best way to go as far as safe investments are concerned. The gold investment theory is based on the idea that fiat currencies will lose value as a result of the printing of money. Although there's some truth to this, the theory is flawed. Most people invest their long-term savings in stocks and assets rather than fiat currencies. Investing in gold with the idea it never loses value is the wrong approach. Gold is subject to supply and demand pressures like any investment or financial asset that cause the price to fluctuate. Of course, gold stabilizes your stock market portfolio when it's added to it. And even though you don't lose money, you don't make any notable returns either. The reason is, gold doesn't pay interest or dividends, and its intrusive value doesn't increase. All in all, gold should be perceived as a barrier against volatility and inflation, but not as a way to generate wealth. 6. Investing and gambling are the same thing. People assume this probably is a way to simplify their view on investing. To some, investing is just a way to make quick cash. But for all those who've done it before, strategic investing is hardly considered a gamble. When you buy a stock, you expect it to increase in value, but this isn't always the case, and its value decreases. But even if this happens, the asset has the potential to rise again in the future. One of the major differences between investing and gambling is that you're buying a certain percentage of ownership in the business when you buy a share of a company's stock. When you look at gambling, you'll note that there's nothing of value you're getting in return when you exchange money for chips in the casino and place your bet. If you have a winning bet, you're given more money back, but if you lose, your money is lost completely. And there's no way you'll gain from the money you gave out at the beginning. 7. A 401k and Social Security are the only ways to save for retirement. Employer-based retirement plans, like the 401ks, are very popular, but it's not the only way to save for retirement. IRAs are one of them. IRAs may have a lower limit on contributions as compared to 401ks, but with these, you're able to invest up to $6,000 as of 2020, or even $7,000 if you're 50 or older, according to the IRS. No one knows the future of Social Security, and many investors know firsthand that employer-sponsored retirement plans don't always work out. Starting young and diversifying through a variety of investment vehicles is the best way to secure one's financial future. 8. The stock market is the best place to invest if you want to grow wealth. Invest in what you know. This is one of Peter Lynch's famous quotes. What this means is that you should invest in areas you're familiar with. Invest in things that give you the upper hand over other investors. Many investors don't take this advice and invest in areas they don't understand well. They place their money in stocks that are always going up, but they don't know the reason behind it. The number of investments that can be made are unlimited. Bonds, commodities, real estate, and currencies are some of the other options you have. A portfolio focusing heavily on stocks might be appropriate for most investors, but if it's not something you are too interested in, focus on something else. There's nothing wrong with investing in stocks, but it's wise to invest in your strengths, not your weaknesses. You could always be creative and come up with something that gives you an edge over others. It's advisable to allocate at least 20% of your portfolio in other asset classes for diversity. 9. International investing is too risky. If you look at current markets, you might find that the US investments are doing better than international ones. But before you write off international investments completely, you should also look back between the years 2000 and 2009. You will discover that a diversified portfolio of international investments significantly outperformed US's larger cap investments. Foreign or international markets can offer significantly less competition and sometimes a marketplace with greater investment opportunities. Although this depends on the country or market you invest in, investing overseas provides investors with a dramatic increase for investment and the potential for significant returns. Sticking with this phrase therefore could keep you from some potentially diversified international investments that could work out really well for you. 10. The professionals always beat the market. It's true that some professionals are able to beat the market sometimes, but studies show that chances of an investment professional outperforming the market is very slim. You might do better with a low-cost fund, but if you think about it, do you really need to beat the market? The main idea behind investing is to meet the long-term financial goals you've set for yourself and not compete with the market. Yes, professionals can assist you in achieving your financial goals and offer insightful advice and manage your money for you, but they won't always beat the market, and you shouldn't expect this of them. A majority of the active portfolio don't usually do as well as the passive portfolio, and the reason behind this is that a broker probably mismanaged your portfolio. Most of them do what's best for them and fatten their own wallets. They tend to overtrade sometimes and raise commissions that won't be in line with the goals you've set for yourself. Your best option would be to employ the expertise of a financial advisor. You'll pay them their dues, and you'll be certain that your investment decisions won't be taken advantage of. This will also assure an increased net worth, since you'll be dealing with professionals. These are just a few of the misconceptions that have spread widely in the investing world. But be sure that there's nothing definite or absolute when it comes to investing. Knowing how to make the right decisions from calculated risks is really crucial. Investing is versatile and can't be reduced simply to a few sets of rules. I hope you guys enjoyed and gained valuable information from this video. If you did, go ahead and give the video a thumbs up. And if you're new to the channel, welcome, and be sure you subscribe for more content like this. With all that said, have a great day, you guys, and I'll see you all in the next one.
3-4 चीज़ें तय हैं। पहली चीज़ तय है कि हम सब मर जाएंगे, दुनिया की कोई ताकत रोक नहीं सकती। दूसरी चीज़ तय है कि जो आज एनर्जी है वो 10 साल 15 साल बाद नहीं होगी शायद, और ये भी तय है कि 150-200 साल की उम्र नहीं है ना। ये 3 चीज़ें फैक्ट है बिल्कुल। तो जो कुछ करना है अगले 4-5 साल 10 साल में ही करना है। तो जिनके पास 19 साल या 20 साल की उम्र है, आप प्रिविलेज हो यार, आपके पास हिंदुस्तान की सबसे अच्छी कंपनी है।